Good morning, everybody. Hey, Kayla. Hey, Nicole. Hey, Matt. Hey, Henry. So we just have about another minute here. While we're waiting, hey, Paul. While we're waiting, I'll just let you know that I will be sending out an email about the test 2 results, as soon as the lecture's over, maybe this afternoon sometime. I don't know, just be looking out for that. Hey, Jason. Hey, Harry. Hey, Ryan. But the investments chapter is pretty long, so I don't want to kind of wait too much longer because otherwise we'll kind of run out of time here. So all that to say, let's kind of jump on here. And so with investments, the first type of investment we're going to talk about are debt securities. Hey Nate, and so with our debt securities, just understand that the firm's going to make certain assumptions when it comes to debt securities, and that's really going to determine how we do the accounting. And so probably more so than any other topic in accounting, debt securities is one where a company's assumptions really play a key feature in the way we do the accounting. And so these assumptions, they're going to affect gains and losses, and how they're reported as part of net income. They're also going to affect the carrying value of the securities on the balance sheet. When I say carrying value, what I mean is when we see the full effect of the debt security on the balance sheet, it's going to look different depending on whether it is classified as held to maturity, available for sale, or trading. And so the question here, and I'll ask you guys to kind of answer this in the chat. I know we're just kind of getting going here, but let's just start right off. Do assumptions affect the real profits related to the investment? And so what I mean by real profits is, if I buy something for $5 and I sell it for $7, I make $2. And so do these assumptions affect that? And so Harry says they do not. Anybody else? Again, just kind of give it a second here. So Thomas says no. That's correct. No. The fact is, these real activities, the firm buys securities, they're going to receive interest payments, they're going to sell the securities. So that doesn't really affect those cash flows. In other words, the assumption doesn't change cash flows, but the assumption can determine when gains and losses are recorded and how they are classified. And so, again, the assumptions don't change real profits, but they do change the way that we account for those real profits. So what are the real profits associated with debt investments? Ultimately, it's the difference between what you pay and what you receive in return. Like I mentioned in the earlier example, if I pay $5 and receive $7, my profit is $2. Now, with the debt security, of course, there are kind of two sources of that. First of all, there's the interest payments. That's kind of the big one that everyone thinks about, is the interest payments. And the second thing is there's oftentimes a difference between the purchase price and the par value if it's held to maturity, or the difference between the purchase price and the sales price if it's sold prior to maturity. Now, in those second two items, the difference between the purchase price and either the par value or a sales price, that's a situation where you could have a gain or you could have a loss. Now, obviously, interest payments, that's a form of interest revenue, and so that's always going to be a profit, but just understand with the last two, it could be a gain and it could be a loss. All right, there are three types of debt securities. Held to maturity, where essentially the company has said we have no intention to sell before maturity. Trading securities is where the company makes an assumption that they primarily intend to sell the shares, or not the shares, but the debt securities in the short term. And then there is this third classification called available for sale. And available for sale is kind of one where, well, the company has not disclosed that they intend to hold it to maturity, and the company has not disclosed that they plan to sell the debt security in the short term. So it's kind of this default, like if you're not telling us what you're going to do, then we're going to classify it as available for sale, which is kind of this in-between classification. And so I will say that the available for sale classification is the source of some controversy because it ends up being that default classification. And even under IFRS, they actually don't allow the available for sale classification. And so I'm not sure how much longer available for sale is going to remain under US GAAP. For now, it's there, and so we need to learn how to account for it. But I could foresee a time in the future where that classification does go away. All right, let's talk about held to maturity securities. So first of all, they are going to be reported on the balance sheet at their amortized cost. In other words, whenever you see the debt security reported, there's no fair value adjustment. There's nothing like that. It's just the amortized cost. That is how they're going to be reported. So if the market value of the debt security changes after it's been purchased, we don't account for it. We don't care. Again, because the idea here is that you're holding it to maturity. And so some major characteristics of the way that we do the accounting. First of all, we record the initial account balance at the acquisition cost. So in other words, whatever you pay for the security, that's what you list the debt security on your balance sheet as. Now, I want you to understand there's more than likely going to be an implicit premium or discount, but there is no separate account. So let's say that a debt security has a par value of $500,000, and let's say that I acquire that for $480,000. We actually list the debt security on our balance sheet at $480,000, and so there is an implicit discount in that situation, but there is no separate account. Now, over time, we will amortize the premium or discount, and that amortization will go as a direct change to the debt security account. So in other words, before, when we had bonds payable, we would amortize the premium or discount. In this case, we still go through the amortization process, but it's a change to the debt security account rather than a separate account. And again, similar to the way we've done it before, it's the difference between the interest that we receive and the interest revenue that we record, and we use the effective interest method. If the security is sold before it matures, there most likely will be a gain or loss. All right, let's walk through an example. So a firm purchases $500,000 of 6% semi-annual coupon bonds on January 1st, 2020 at 98.5. The bonds pay interest on June 30th and December 31st each year, and they mature on December 31st, 2022. Each bond has a face value of $1,000. They sell 200 of them, and they hold the remaining until maturity. So let's provide the journal entries for these various dates, and let's also provide any financial statement effects for 12/31/2020 and 12/31/2021. Now, I will say on the test, so just this is sort of like one of those news flash kind of things. On prior tests, we didn't push you really hard on understanding exactly how all this stuff shows up on a financial statement. For this test, you are going to be responsible for that. Now, again, it's not half the test or anything like that, but there are going to be specific questions asking you about the financial statement effects. And so on every one of these, I'm going to be walking you through the financial statement effects, and just know that I'm not doing this just for extra information. We're actually going to be testing you on this. And in fact, now we don't do it in the summer, but usually every other spring, the accounting department, the School of Accountancy, has to go through an accreditation process. And part of that is to track student learning on certain learning objectives. And one learning objective that we have is how to account for certain activities and then also understand how they impact financial statements. And so this is the chapter where we decide we're going to really emphasize that. And so just be paying attention to that as we move through it. Okay. So let's talk about the initial acquisition. First of all, we do have the cost of the debt investment. Again, the price is 98.5, which means that we acquired it for 98.5% of the par value. So we paid $492,500 for this debt investment. Hopefully the journal entry itself is not too difficult. January 1st, 2020, we're going to debit the debt investment and we're going to credit cash. Now in this particular case, the acquisition of the debt investment coincides with the interest payments. So notice that the interest is paid on December 31st and we acquired it on January 1st. And so this is a fairly simple, straightforward example because we don't have to accrue any interest or anything like that. Most of the time, when we acquire a debt investment, it will not coincide with the interest payment. And so in those cases, you do have to accrue interest, and it becomes a little more complicated. And we'll go through an example where we have to do that, of course. All right, so the next step after we record the acquisition is now we have to sort of move through time, and we have to start recording interest payments and all those kinds of things. And so the first thing we have to do is apply the time value of money to any of the remaining entries. And so we have enough information from the contract to get a lot of information related to the time value of money calculation, but ultimately we do need to solve for the yield. And the reason we need to solve for the yield is because we must use the effective interest method. And so how do we do that? First of all, we're going to kind of walk through the buttons. So our N is the remaining maturity. Now, this bond could have been issued 10 years ago. For the purpose of our time value of money calculation, we're calculating the present value now. And remember, it's the present value of all remaining cash flows. And so that's why our N is just the remaining maturity, because the only thing that we're concerned about is the remaining cash flows. Not all of the cash flows, just those that remain. The price that we pay is the present value. The interest payments, of course, are going to be the payment, and the par value is going to be the FV. And so we use all that information then to solve for the I/Y. And so in this case, we acquire it, if we kind of go back to our example, we acquire this on January 1st, 2020, and so we have 2020, 2021, 2022, so 3 years, but it's a semi-annual bond, and so there are 6 semi-annual periods remaining. And so that's why our N is 6. The present value, and now for what I do for these bonds, and you're going to kind of see this as we create the amortization table, is I do everything on a per bond basis. And the reason that I do that on a per bond basis is because we could sell some but not all of the bonds. And so having the amortization related to each individual bond allows us to kind of track through things without getting too confused. And so we're going to do the TVM based on one bond, knowing that at various points in times we may be applying this to more than one bond. And so the PV, we paid 98.5% for each bond. So we paid $985 for each bond. The interest payments, if you look at the contract, it's a 6% semi-annual coupon bond, which means that it pays 3% every 6 months. And so 3% of $1,000 is $30. And of course the par value for each bond is $1,000. I'm going to stop right there. I want to make sure everyone follows that. So just kind of give me a yep, got it, just to make sure you see what I did there. I transitioned to doing the time value of money calculation on a per bond basis. And I just want to make sure everyone's following that before I move on. Thanks, Harry. Thanks, Jason. Good. All right, great, Ryan. Great. Thanks, Nicole. All right, sounds like we're good to go so far. All right, so then when we solve, again, we put all the information into our time value of money calculator, and then we solve, and we get the semi-annual yield of 3.2795%. And so, of course, that's somewhat to be expected because we purchased this bond at a discount, which means that the yield must be more than the contract rate or the bond rate. And so that's why the yield is 3.2795%, whereas the bond rate is only 3% semi-annually. Okay, so now we're going to create the amortization table for each individual bond. Now, with this amortization table, we're going to take everything out to the nearest penny. On the test, now you're going to be very, very, very grateful for this. On the test, I'm going to give you the amortization table. Now, you need to know how to use it, and I'm not going to label the columns, but you're not going to actually have to do any calculations for the amortization table. I feel like in Chapter 14 is where we really emphasized in creating these things. In Chapter 17, I want to focus more on how do we use the amortization table. Now, you're going to be creating amortization tables in the future in future chapters, but for this particular chapter, you're going to be given the amortization table. Yeah, exactly. All right, so let's take a look here. So this is the full amortization of each individual bond. Now, again, I'm going to go through how this is done just so that you can see it. But of course, you don't have to know how to calculate this. So the initial carrying value, hopefully that's obvious that that's the price. The ending carrying value is the par value, because remember, with amortization, we're taking it from the discount balance to the par value, and so we're getting rid of that implicit discount. Now the cash received column, hopefully that's obvious, that's the interest payment. And then the interest revenue is just the yield multiplied by the carrying value. And so $32.30 is that 3.2795% times $985. And so that's where we get the $32.30. The amortization, of course, is the difference between the interest revenue and the cash that we receive. And because this is a discount bond, we know that the amortization is going to increase the carrying value of the bond until we get to the par value. So hopefully that makes sense. And then, of course, we just continue through that process all the way down. Similar to what we had done with the bonds payable, the amortization table for a debt security is going to be built around the interest payment dates. Notice that in this case that happens to coincide with the fiscal year end, but that won't always be the case. Much like with the bond payable, it was not always the case. I'm just going to pause there a second in case somebody's writing down the calculation before I move on to the next slide. Okay, so now we're going to use the amortization tables to complete the journal entries for each interest payment. So we're going to start with June 30th, 2020. So looking at our amortization table, we want to focus in on that 6/30/2020 row, and we can see the cash that we receive, we can see the interest revenue, and we can see the amortization for each individual bond. Now, of course, this is for one bond, and so we need to pay attention to how many bonds that we have at any particular point in time. So the cash that we receive, of course, is $30 per bond, and at this point in time, we hold 500 bonds. Now, I never said 500 bonds explicitly, but going back to the problem, hopefully it's fairly obvious. So the total purchase was for $500,000, and each one has a $1,000 face value, which means we must have purchased 500 bonds. Alright, so again, the total cash that we're going to receive is $15,000. The total interest revenue that we should record is the interest revenue per bond, $32.30. We apply that to the 500 bonds that we still hold for a total interest revenue of $16,150. And then, of course, the amortization of the debt investment is the $2.30 times the 500 bonds for a total of $1,150. And again, remember, we're amortizing an implicit discount, and so the amortization goes as a direct increase to our debt investment account. Now, as far as the journal entries themselves, the cash that we receive, hopefully that's obvious, that's a debit, we're receiving cash. Interest revenue, hopefully again it's obvious that interest revenue is a credit. Now the one that sometimes students will get mixed up on is what to do with the debt investment as far as whether it should be a debit or whether it should be a credit. Probably in the math it's fairly obvious that it needs to be a debit, but rather than just sort of thinking of it that way, I want us to instead think about what's going on with the amortization process. Notice what's happening to the carrying value of this debt investment over time. It's going up. Well, the debt investment is an asset, and so we know that assets increase with debits. And so with a debt security that was acquired at a discount, the amortization is going to be debits to that account. If it had been acquired at a premium, then it would be going from a higher value down to a lower value. And in that case, we would need to credit the account in order to reduce the account balance. And so again, when you have an acquisition for a debt investment at a discount, the amortization is going to be a debit to the account. Whenever we acquire a debt investment at a premium, the amortization is going to be a credit to that account. So there's our journal entry on June 30th, 2020. Of course, debits to cash in the debt investment, and the interest revenue is a credit. Good so far, everybody? Okay, here we go. All right, let's record the partial sale on August 30th, 2021. Now, we would have continued to do our journal entry on 12/30/2020 and also 6/30/2021. And so now we're kind of fast forwarding all the way to August 30th, 2021, because I figure if you can do the interest payment on June 30th, you can do any interest payment. So that's not what I'm worried about. But we're going to kind of fast forward ahead to August 30th, 2021 and figure out what we need to do. All right, so first of all, again, we have our amortization table, and whenever we kind of fast forward into a situation, we need to figure out, okay, where are we on this darn table? What are the relevant pieces of information? And so I've kind of highlighted them here, and I'm going to kind of walk you through each piece. Well, first of all, whenever you see that row, December 31st, 2021, what that really means is that's the culmination of 6 months ending on 12/31/2021. And so when we talk about the cash received, of course that's the cash payment that we're going to get on 12/31/2021. But that's also if you want to think about it a different way, that's the contractual cash that I've earned that I'm going to have to be paid, and it culminates on December 31st, 2021. But if you think about it, I start getting owed that cash on 7/1, on July 1st, 2021. They owe me 1 day of interest according to our contract. And the next day they owe me another day. And the next day they owe me another day. And the next day they owed me another day. And that just kind of continues throughout that 6-month period until it culminates into $30 at the end of 6 months. And that's when they actually make the payment. And so that's kind of the way that we need to think about that. It's the 6 months that end on December 31st, 2021. It's the same way to think about the interest revenue. Again, we talk about with interest expense, if you remember, we incur the expense continuously, we record the expense periodically. The same is true with interest revenue. We earn the revenue continuously, we record the revenue periodically. And so that $32.54 is the revenue that we earned for 6 months ending December 31st, 2021. And so think about it. We're at August 30th, 2021. That date lies between June 30th, 2021 and December 31st, 2021. And so because of where that date lies, we know that the relevant interest revenue is the 6 months that end on December 31st, 2021. I want to stop there and give you a second to ask a question to make sure you're following this, because this is something you really got to understand. A very common mistake is for students to grab the wrong row when they're thinking about how to do these journal entries. So again, I'm just going to give it a second in case somebody has a question. Okay, so the same with the amortization. 6 months of amortization that ends on 12/31/2021 is the $2.54. Now, I jump up to the prior carrying value. Again, I want to be careful what we're talking about here. So on August 30th, 2021, I'm going to be selling some of these debt investments. And we got to ask ourselves, well, what is the amortized cost of those debt investments at the time of the sale? Well, the last time that I would have updated that account balance would have been June 30th, 2021. And so the amortized cost at this point in time is still $992.14 because we haven't made any updates. And so again, whenever you come to the sale, you got to think about, in this massive amortization table, what is the relevant information? It's always the prior carrying value and then the information for the 6 months that are going to end that include that date. So Harry asks, when we record gain or loss on sale, we use the prior carrying value and do not incur. That is actually not true. So we do use the prior carrying value. That's true. But we still are going to need to accrue interest revenue. So there's a lot of things that are going to go into this journal entry, because remember, when I sell this debt investment, I'm going to get a partial interest payment. I'm going to receive whatever price I've negotiated. And at the same time, I'm going to earn some interest revenue. I need to record that. And so all this information kind of comes together, and then we take everything off of our books and we figure out if there's a gain or a loss. So it is a bit of a complicated journal entry. And I will say right now, on the test, you're going to have one of these journal entries, and it's worth enough points where you're going to want to do it right. All right, so let's record that partial sale. So first of all, what are we going to receive in terms of cash? Whenever we sell it, first of all, we're going to get whatever negotiated price we have. And they also have to pay us any accrued interest. So again, on August 30th, 2021, there would be the July interest and also the August interest that would be owed to me. So those are the two pieces that were going to be owed. So again, the price was negotiated at 101% of par, and we are selling 200 bonds. And so the total price is $202,000. The accrued interest, again, 6 months of interest is $30 per bond. We apply that to the 200 bonds, but of course, we only accrue 2 months interest on August 30th, 2021, when this sale takes place, for a total of $2,000. All right, so again, the cash that we're going to receive is both the price and the accrued interest for a total of $204,000. And again, this is a very common mistake that students forget to include the accrued interest, but you've got to include the contractually accrued interest. We also do need to accrue the interest revenue. Again, we just talked about the $32.54 being the interest that is accrued between July 1st, 2021 and December 31st, 2021. And so we're partially accruing that $32.54 per bond for the 200 bonds that we're selling, and we're going to accrue 2 out of the 6 months on this date. So for a total of $2,169 in interest revenue. Again, I'm just going to bounce back to the amortization table. The $32.54 is where we got from the interest revenue column. Is there a reason to charge the interest separately rather than simply selling for 102? It wouldn't be exactly. I see what you're saying. It would. I don't think it would be. Would it be exactly 102? It just happened to work out this time. Sometimes I will say, Jason. So the answer is you can do it that way. Most often when the price is negotiated, there's a price that's distinct from the accrued interest. I have seen in the market, though, where a price is quoted that includes the interest. And in that case, you're right. We would not have to separately accrue the interest. But for the purpose of this class, I want us to kind of clearly understand that there are two components to this price. There's the sort of the market value of the bond itself, and then there's the accrued interest. But you are correct. You could sell it just as at one negotiated price. We are not going to do that for this class because I want you to see the two components separately. Does that make sense? Okay, good. All right, so then we got the interest revenue. We have to take the debt investment off of our books. Remember again, we're using that prior carrying value, the $992.14. We're applying that carrying value to the 200 bonds that are being sold for a total carrying value of $198,428. And then there almost certainly is going to be a gain or loss, and so if there is a gain or loss, that's just simply a plug. So that's the components of the journal entry. All right, let's take that information. We have the cash that we receive, we have the interest revenue, we have the debt investment, and let's throw this all into our journal entry. And so, of course, the cash that we receive is a debit for $204,000. We're taking the debt investment off of our books. That's an asset, so to take it off our books, that's going to be a credit. And of course, we know that interest revenue is a credit as well. And in this case, that means we are going to have a gain on sale. And the gain on sale would be $3,403, and that's just a plug. Now, there's two ways to think about the gain on sale or the loss on sale. If you need a credit, it's a gain. If you need a debit, it's a loss. The other thing to think about is, did I receive more cash than the book value of what I was quote-unquote entitled to? So the economics is basically saying, well, you know, I received, or the debt investment was worth $198,428. I earned $2,169, and so, you know, I should have received just a little over $200,000 if my books were 100% up to date with the market value of what was going on. But instead, I received $204,000. So I received more money than what I was quote unquote entitled to on my books. Therefore, it was a gain. If I had received less money, then it would have been a loss. Sure. So Paul wants me to explain again the row. Let me go back to it. So again, whenever you're looking at this, the date that we're referring to here is August 30th, 2021. That's kind of what we're focused on. And so we're saying, okay, when does that date occur? And you can see that it lands in between June 30th, 2021 and December 31st, 2021. And so then we have to think, okay, what is the relevant information for that date? Well, we know that the 12/31/2021 row is going to capture the cash that we're owed and the interest revenue that we've earned and for the 6 months that end on December 31st, 2021. Well, guess what? August 30th, 2021 is part of that 6 months. And so that's why we need to use that row. And of course, the amortization goes right along with that. However, the carrying value is the carrying value at the end of the 6 months. And so when we talk about August 30th, 2021, we have not updated the carrying value on our debt investment yet. So the carrying value at the time the sale is made must be taken from the prior row, the June 30th, 2021 balance of $992.14. Again, if you want to think about that last column, it's more like a balance sheet where it's a point in time, whereas the first three columns more like are an income statement where something is kind of happening over time, if that helps at all. But again, that's definitely something you got to get your arms wrapped around, Paul, because on the test I'm going to give you information, but you need to know what to grab onto. Okay. So now to complete our journal entry for December 31st, 2021, we need to go back to the amortization table. And again, in this case, hopefully it's fairly obvious that we're on December 31st, 2021. So now everything's getting updated to December 31st, 2021. But remember, we sold 200 bonds. And so now there's only 300 bonds that still remain on our books. And so when we apply this information, we're going to be applying it to only 300 bonds rather than the 500 bonds we had applied it to in the previous year. So the cash that we receive, again, is $30 per bond, but now, again, applying it to 300 bonds. That's a $9,000 debit. The interest revenue, did I grab the wrong number? Yeah, no, I didn't. So it's $32.54. Again, we apply it to 300 bonds, so that's $9,762. That's a credit. And the amortization, of course, the $2.54, we apply to only 300 bonds, and so that's going to be a $762 debit. And there is our journal entry. Again, this is very similar to the June 30th, 2020 journal entry. We're taking the information from the amortization table and we're applying it to the number of bonds that remain on our books. And in this case, there's only 300. Again, I moved a little more quickly through that journal entry. Okay. So let's talk about what's going to be reported on our financial statement. So what's going to be reported on the balance sheet? The debt investment is an asset, and it's going to be reported at the amortized cost. This is the last column in the amortization table. So the debt investment is being reported at its amortized cost, and that is the last column of the amortization table. How about the income statement? The firm is going to report interest revenue as a non-operating income item. So it is part of net income as a non-operating item. If the security is sold before it matures, then there's going to be a gain or a loss, and that's also part of our non-operating income. It's a non-operating item. So let's talk about the balance sheet, the debt security balance. So we're going to look at December 31st, 2020 and December 31st, 2021. And so again, we're going to refer to the amortization table. So the two dates that are relevant to us are the 12/31/2020 carrying value. Again, that's synonymous with the amortized cost. And the 12/31/2021 information, again, that is the amortized cost. That last column captures the amortized cost. That's what's going to be reported for the debt investment on the company's balance sheet. So 989.68 and 994.67. So on December 31st, the balance, of course, at that time we have 500 bonds, but in 2021 we only have 300 bonds. And so when we report those account balances, the debt investment is going to be classified as an asset, and it's going to be reported at those two amounts on December 31st each year. I'm going to kind of pause there as you guys try to, I think in the notes you're kind of having to fill in a little more on this one. I try to leave you guys, I think I left you like a little table. Can somebody verify, did I put a table in the notes for you guys to fill in for this? No, maybe I didn't then. I don't have my notes sitting in front of me. Oh, I'm sorry, Kayla. Okay, so there's no chart. Well, sorry about that. So I'll go slower because I know you're going to be writing a lot more. So I'll definitely slow down as you write this information in. So just kind of with each of these, we're going to kind of have the classification of the account name, and then the two dates that are relevant. And so I know there's a little more writing, so I'll slow down now. Usually in class, I'm writing this on the board with you, so that's why. But it's already typed up, so it moves a little faster. I said one more thing. Let me go back. Oh, probably the gain or loss on sale. The gain or loss on sale is going to be a non-operating item as well. I'm guessing that's the piece you were missing there, Harry. Okay. So let's talk about the income statement. Why didn't you take 4/6? Oh, because I held those 300 bonds for the entire 6 months. So the reason we had 2/6 on August 30th is because I was doing some transactions where it only applied to 2 out of the 6 months. But for the remaining 300 bonds, that interest revenue and interest payment, that's a full 6 months. I didn't record anything for them on August 30th, and so on December 31st, I need to record the full 6 months. Okay. So for the income statement, yep, good. We do have to record the interest revenue. So we're going to record it for the year ending December 31st, 2020, and also 2021. And we are going to have that gain on sale from this that's going to be reported for the year ending December 31st, 2021. We're going to use the amortization table and journal entries to kind of get all this information. But again, you're kind of walking through thinking about what did we have? What were the income statement related items? Was there interest revenue? Almost certainly. Were there any gains and losses? And in this case, there was a gain on sale in 2021, even though there wasn't anything in 2020. So referring to our amortization table, we're talking about 2020 and 2021. So there's actually, 4 rows that are relevant for this, and it's the interest revenue from the June 30th entry, the December 31st entry of 2020, and then the same 2 entries in 2021, along with, because it's part of it, the August 30th, 2021 entry. So don't forget about that August 30th, 2021 entry because we did record some interest revenue on that date. So we have lots of information here that we need to take into account for our income statement. Again, the reason why I highlighted the 3254 is because we know that that applies fully to only 300 bonds and it applies partially to 200 bonds. And so that's why I highlight that as a slightly different color because it doesn't get the exact same treatment as the other 3. All right, let's talk about 2020. Again, on June 30th, we had 32.30 per bond. We had 500 bonds. Similarly, on December 31st, we have 32.38 per bond, still 500 bonds. And so the total interest revenue for 2020 is $32,340. And again, I'm going to slow down there, but that information comes from the amortization table, and we're taking the June 30th, 2020 amount and the December 31st, 2020 amount, and we're applying it to all 500 bonds because we held them all for the entire year. And so that's why our total then is $32,340. That's what we're going to report as interest revenue on December 31st, 2020. Again, going back, that's where we got that information, the June 30th amount, the December 31st amount, applying it to the 500 bonds. So now in 2021, we have the June 30th journal entry of $32.46 per bond, and we still had all 500 bonds. And so that means our interest revenue for that date in total would have been $16,230. Now on August 30th, if you recall, we partially record interest revenue for the 200 bonds that we sold. Again, that's because we only held them for 2 months before we sold them. And so the total amount of interest revenue that we recorded on that date was $2,169. And then on December 31st, we recorded a full 6 months of interest for the 300 bonds that we held for the entire 6 months for a total of $9,762. Which means our total interest revenue for 2021 is $28,161. I just realized that I'm operating on Wi-Fi right now. So give me 1 second while you guys catch up, and I'm going to plug in to a hard line. Hold on 1 second. Sorry about that. I'm using my my desk in my sitting room, so it's a different setup that I'm used to. Let me make sure I turn off my Wi-Fi, because otherwise it's going to get confused. Alright, if y'all just want to verify that it's back. Would somebody mind just making sure, like, yep, we're good. I think it popped off for a second. Okay, good. Thank you. Yeah, the with 4 kids and multiple devices, as soon as they all get on my Wi-Fi, it kills it. And so I just had to kind of take a second and get off Wi-Fi and use a hard connection. That way I don't have to compete with them for bandwidth. Hopefully it re-catches up there, Harry. Alright, and then of course we have the gain on sale in 2021 as well. Alright, so this is all the information that we have that is related to the income statement. Our 2020 interest revenue, our 2021 interest revenue, and the 2021 gain on sale. And so those are all non-operating items, and we would report those on our income statement in both years. And hopefully by the time you get to this piece of it, it's not too bad. And so on a test, if you could imagine, sort of having a box where you got to fill in, like, okay, how much do I report? That's just kind of going to be the general way that we do that. All right, is everybody caught up? Okay, now available for sale securities. So now we're making a transition from held to maturity to available for sale. And so the good. All right. So unlike held to maturity, remember those are reported at the amortized cost. For the available for sale security, it's going to be reported at the fair value. All right. So now I want to be clear though. The balance in the debt security or debt investment account is the same. It's still the amortized cost. But now we're going to have an additional account that we have to report called the fair value adjustment account. And so in total, when you kind of lump those two together, you're going to see the fair value being reported, but it's still two distinct accounts. But the fair value is what's going to sort of in total be reported on the balance sheet. So it is a little bit different. Major characteristics. The initial purchase and amortization of any premium or discount, it's exactly the same. So all the journal entries that we just did for held to maturity, we're going to have to redo all of those journal entries for an available for sale security. We still have to do all of that. Nothing has changed. We still have the interest revenue, we still have amortization, we have all of that. That still continues. The difference, though, is that the firm is now, in addition to all of that, going to make periodic fair value adjustments. And because this is available for sale, those fair value adjustments that result in what's called an unrealized holding gain or loss, and again, we're going to talk about all this in as we move along, but that's going to be reported as accumulated other comprehensive income. Okay, so all this to say that in addition to everything we've already done, now we have to do these fair value adjustments, and we're going to have unrealized holding gains and losses. Again, we'll talk about that account in a minute, and all this is going to be a part of accumulated other comprehensive income, otherwise known as AOCI. If the security is sold before it matures, just like held to maturity, there most likely will be a gain or loss. All right, so what is accumulated other comprehensive income, and why is it the source of at least some debate? Every time I come to this particular point, I think especially after the second test, and you don't have to put it in the chat, but maybe you can answer to yourself. Like, usually by now there are several students that come to the point where, like, man, I really thought I was good at accounting, and then they have the first two tests in intermediate 2, and they're like, maybe I'm not so good at accounting anymore, and they really struggle with, like, is this something I'm good at? Is this something that I'm not good at? And I just want to kind of reassure you that if you made it to intermediate 2, you are way, way, way above average when it comes to accounting. Way above average. If you think about when you were in your introductory class, your first Principles 1. Ha, that's funny. In that first class, if you think about who's sitting around you, most of those students would never have made it through intermediate 1. Let alone at least on some level getting through intermediate 2. Now again, some of you are struggling, but I don't think it's unlikely that it's because you're incapable. I think a lot of times when students struggle in intermediate 2, it's that it does require more time than probably what you previously had to give to accounting. Secondly, with the summer schedule, you kind of have a double challenge because the schedule is so compressed, and so you're having to learn everything so fast. And instead of being able to digest things over 2 or 3 weeks, you're having 1 week then a test, 1 week then a test, and so it's a whole different deal. And I know that when you struggle, you can start to get some self-doubt. You can start to think, I'm not that good. But I'm going to tell you right now, like, you're in this class. You're very, very bright. It's just the reality. You're very bright, and I want you to take confidence in that. Now, you might have to work harder than you thought you're going to, and you might not get an A. You might have to be thankful for a B or a C, but I'm confident that if you put in that time, you can do it. And so sort of in the context of this question, that for you who are, in the grand scheme of things, probably way above average when it comes to your accounting knowledge, for most of you, you've never heard of AOCI. And even if you've heard the term, you really don't know what it is. And so that's kind of why, or that's sort of like, what is accumulated other comprehensive income? Well, there are a lot of people like yourselves who know a lot about accounting who don't know what AOCI is. And so let's answer that question right now. So comprehensive income is reported separately from net income. In other words, it's income that's not typically included in an income statement. All right? And so these items usually are what are called unrealized gains and losses. Other things can also create these things, like entries from pension gains and losses, foreign currency translation adjustments. Those are just a few. But there's a lot of these items that are, quote, income items, but they're not reported as part of net income. So really what it's saying is there's the income statement that you've always thought about that ends in net income. There's also this whole other thing below it called other comprehensive income that most students have never heard of. And that's one of these items. So the comprehensive income is the income statement item. The accumulation of that is the accumulated other comprehensive income account. It's sort of the equivalent of retained earnings, but for other comprehensive income items. Okay? So it's this really squishy thing where, okay, you haven't sold it, but it went up in value. You might sell it, you might not sell it. Those kind of, it's like this squishy, not sure exactly how to treat it, and so we throw it into this category called other comprehensive income, and we accumulate its effects in the accumulated other comprehensive income, and AOCI is reported on the balance sheet as a permanent equity account. So just like retained earnings is a permanent equity account where net income accumulates, this is a permanent equity account where other comprehensive income accumulates. So I want to stop there and make sure I answer just any conceptual issues that you have with what is AOCI. Again, it's just squishy other items that aren't part of net income, but they're kind of still are income. It's really kind of squishy. Okay? All right, second question then. Again, this is the AOCI is the cumulative balance, much like retained earnings is a cumulative balance for the net income. Again, these are things that I did talk about. All right, second question. Why is it the source of at least some debate? All right. So, some argue that this separate account reduces distortions of earnings that would be reported on the income statement. In other words, if you have all these items that are really squishy, that aren't really well understood, and let's say that they all impacted net income, they impacted the earnings of the company, that would create distortions in how that earnings number is interpreted. And so what you end up with then is stock price volatility, kind of, I would say, unnecessarily, because it's not. It's because a lot of people who trade on information trade on incomplete information. In other words, they really don't know what they're trading on. And so one reason why US GAAP permits this other classification is so that earnings as reported would be less distorted by these items. On the other hand, they're like, wait a second, like you could be misled by these distinctions. And this is especially problematic because manager assumptions are the thing that's driving this. And so this could create, I would say, some opportunistic behavior on the part of managers. And so it's like this balancing act of, well, okay, you can be misled, it can be manipulated, but at the same time, if they're trying to be honest, then it can be misinterpreted. And so that's the debate. And so the whole idea here is, do we favor a situation where it's going to be a little more devoid of manipulation, or do we create a situation where it's going to be devoid of misinterpretation? And so what they've really done under US GAAP is they're more concerned about the misinterpretation, and they figure there's other ways to enforce manipulation. And so that's why we have that. Now IFRS went the other way. IFRS does not permit this classification, and so they are different in that regard. Okay, let's talk through an example. $800,000 of 8% annual coupon bonds on June 31st, 2020. It should be June 30th, whatever. At 100.5. Each bond has a par value of $1,000. They pay interest on December 31st. There's a fair value at the end of the first year. They sell some. Lots of things going on. Let's kind of walk ourselves through this one. So, first of all, notice that the interest is paid on December 31st, but the purchase is made on June 30th. So that does create an issue where we're making the acquisition in between interest payment dates, and so that complicates things. And of course, the fair value adjustments are going to further complicate things, and so this is kind of an all-you-can-eat kind of a problem. Let's kind of walk through each piece. So the first one is to figure out, well, whenever we make the acquisition, of course, we have to pay the seller the price that we negotiate plus any accrued interest. And so, of course, the price is listed at 101.5, which is 101.5% of the par value. So we're going to pay $812,000 in total. And then the interest, the coupon rate is 8% annually applied to the par value. But of course, when we purchase this on June 30th, we only have to pay half of that because that's how much is owed to the seller. And so in addition to the price, we have to pay accrued interest. So the total amount would be $812,300 and plus the $32,000. Now, I want to be clear, though, that the cost of the debt investment is just the price. And so when we talk about the debt investment account, it's only going to be the price. The accrued interest needs to be treated separately. So in other words, we have this cash that we're paying as a credit. We're bringing the debt investment onto our books as a debit, but understand the cost, the amortized cost, is what we're going to bring it onto our books for the debt investment account itself. So the $812,000 is the only amount that we're going to assign to the debt investment account. The interest, the interest is going to be recorded as interest receivable. And so that $32,000 is going to be recorded as interest receivable, knowing that on December 31st, 2020, I'm going to receive a full interest payment of $64,000. And so that receivable basically stays on our books until that very next interest payment is made. And so that's the way that we're going to account for this acquisition in between interest payment dates. So again, you have the cash paid, you have the cost of the debt investment, which is the price, and then you have any accrued interest as interest receivable. So then that is the journal entry. Okay. All right, so now we have to use the time value of money for the remaining entries. Again, we're going to solve for the yield. Same calculation that we did before. Ryan says, so that half of accrued interest is accounting for January through June. Yes, 100%, because we have to pay the holder of the bond who sells it to us for any interest that was accrued while they held the bond. So if this had happened, let's say on March 1st, then I would have had to pay them 2/12. Rather than 6/12. Does that make sense? Well, hopefully. Okay, good. All right, so now the only difference here that I would say there's a little bit of a wrinkle, and that's the N. And so when we talk about the remaining maturity, what we're really saying is, well, how many years remain? No, it's all right. How many years remain in the life of this bond? Well, it's 5.5 years, and so the N is 5.5. If it had been semi-annual periods, it'd be something else. But just understand, it's 5.5 years, 5.5 periods remain on the life of this bond. Of course, the PV is the price that we paid. The payment is the contractual, the bond rate applied to the par value, and of course, the par value is $1,000. So again, I'm hoping that the TVM for this bond is not a huge leap for us anymore at this point. So then we solve, we get a bond yield of 7.6557%. Again, this is expected. The bond rate is 8%, and it was issued, we bought it at a premium, which means that the bond rate is more than the bond yield, and so the bond yield is, of course, less than the bond rate, which is what we would expect. All right, so now let's create the amortization table. Now it's a little bit different. Notice that the interest payments still coincide with the fiscal year end. On June 30th, 2020, we have that initial carrying value, but notice that on December 31st, 2021, I only have basically 6 months. And the reason why is because that's that half period. So there's only half a period here. And so because that's the half period, the cash that I'm receiving really is net 40, right? Because I'm going to get 80, but I paid 40 per bond. And so the net cash that I receive is 40, and the interest revenue reflects only 6 months of interest revenue, not a full year. And of course, the amortization is still the difference between the two. I'm using the negative number again because the carrying value is going from a premium down to the par value. And so the amortization is decreasing the carrying value of that bond, or the amortized cost of the debt investment. And so that really is the only wrinkle, is that that first row reflects 6 months rather than 12 months because I only held the security for those 6 months. Everything after that then, of course, is a full 12 months with every payment. All right, so then let's provide the journal entries. So we have the acquisition, and now we're going to kind of walk through the rest of them. So again, we're going to complete the journal entries for every interest payment starting with December 31st. Again, we're taking the relevant row is that first row. The cash that receive is 40. Again, that's the net cash. So we got to keep that in mind. The interest revenue, 38.85, and the amortization. So let's kind of walk through how we do this. So the cash that receive, of course, the contractual interest payment is $80 per bond for a total of $64,000. Again, in the amortization table, it's listed as 40, and the reason why it's listed as 40 is because I'm going to receive in total 80, but remember I prepaid, or I paid the seller 40. So that's the net number. So just got to keep that in mind if you see one of these partial period situations. So again, $64,000 is the total cash that I'm going to receive. I have to take that interest receivable that I previously recorded. I need to take that off my books for the $32,000. So sort of the net amount there is that $40 is $32,000 total. The interest revenue from that chart, $38.85 per bond times the 800 bonds, and the amortization, of course, is the difference. The $1.15 times the 800 bonds for $920. And that's our journal entry. So let me go back to the computations because you're probably still writing that down. So again, the cash that I receive is $80. I have to take the interest receivable off my books. I have to accrue interest revenue, and I have to amortize the debt investment. And so the journal entry then is a debit to cash, and a credit to interest receivable, credit to interest revenue, and credit to the debt investment. Okay. All right, let's move to the next one. So again, back to the information. The fair value of each bond is 101 on December 31st, 2020. That's the next piece of information. So we just recorded the interest payment. Now, because this is available for sale, we need to record the fair value adjustment. And so the fair value of 101 means that, okay, I purchased it 101 and a half, and now 6 months later the fair value is 101. So we need to account for the change in the fair value. Because it's available for sale, we need to account for the change in the fair value. With the held to maturity security, we did not have to do this. And so unlike available for sale securities, I should have said, unlike held to maturity securities, we must also record the fair value adjustment. So what is the fair value of each bond? So this is the method that I use. Now, there's not only one way to do this. This is just a method I use every single time so that I can apply the same systematic approach in order to get the correct answers. I would say most students, if they're haphazard about their approach to this kind of a problem, they end up getting a lot of information wrong. And so what I would suggest to you is this is one system. If you don't like the way that I do it, you need to have a system that's repeatable for you. And so this is just the way I do it. So the fair value of each bond is $1,010. The amortized cost of each bond is $1,013.85, and we take that information from the table. Let me go back to the table to show you. So the table, you can see that the carrying value, that last column, which is also the amortized cost, is $1,013.85. That's where I got this information from. So when I go forward, the amortized cost is $1,013.85. So what does that mean? Okay, notice that the amortized cost is more than the fair value. So that implies that the fair value adjustment balance per bond should be negative. Now the fair value adjustment account, it is an asset. And so if it has a negative balance, that means it should have a credit balance. So the fair value adjustment account, it's an asset, but it's an asset that can have either a positive balance, which would be a debit balance, or it can have a negative balance, which would be a credit balance. And so that fair value adjustment account is coupled with the debt investment account, so that together they give you the fair value of the investment overall. And so we have to separate it out, figure out, okay, what portion of it is the amortized cost? That's what the debt investment account balance is. And then the second piece is, well, how do we reconcile the debt investment account balance, the amortized cost, to the fair value? We use the fair value adjustment account in order to do that. And so, again, the fair value adjustment account balance is negative $3.85 per bond. So, there is no prior balance to our fair value adjustment account. And so now we have to get to the entry. And so again, given there's no prior balance, the entry amount is $3.85 per bond. We apply it to the 800 bonds, and that's a total of $3,080. But again, it's a credit because we know that the account balance in the fair value adjustment account needs to be negative. And the negative is going to be a credit, again, because the fair value adjustment account is an asset. So the entry amount is $3,080, and that is a credit entry. All right, so we're crediting our fair value adjustment account, $3,080. The other half of that entry, and I can see that it's slightly cut off. That stinks. Let me see if I can fix that. See if that moves it over at all. Hold on one second. Oh, sorry. Let's get back here now. All right. Hopefully there, I kind of cut off part of the chat. I apologize for that. But hopefully you can kind of see it now. All right. All right. So we do have the fair value adjusting entry here. So the fair value adjustment account is a $3,080 credit. And the other half of that is called an unrealized holding gain or loss. Now, notice that in this case, I specifically designate the unrealized holding gain or loss account as an equity account. Now, US GAAP does not prescribe an account name. I'm trying to be consistent with the book. And all we really need to do is we need to distinguish the unrealized holding gain or loss associated with an available for sale security from an unrealized holding gain or loss that's associated with a trading security, because they are slightly different. And so we have a designated, we say dash equity, basically to suggest that this is a permanent equity account. This is reported on the balance sheet. All right, so this unrealized holding gain or loss, the balance in that account, if it says dash equity, the balance in that account is reported on the balance sheet. It's a little bit different with the trading security. We're going to talk about that when we get there. But just understand, this is the book's way to distinguish between the two types. You don't necessarily, in practice, you might use different account names. For this class, you need to be consistent with the book and consistent with the lecture, because I just want to make sure that we all understand when we're dealing with available for sale compared to when we're dealing with trading. And so those are the two halves of that transaction: the $3,080 credit to the fair value adjustment, and of course the offsetting debit to the unrealized holding gain or loss dash equity account. Okay. So we continue on. So now we have the April 30th, 2021 sale that we have to deal with. All right, so what information is relevant to this sale? It's sort of like we had done before, where we have, we have to kind of think about where we are in time. So on April 30th, 2021, we're in that period of time between December 31st, 2020 and December 31st, 2021. And so the interest revenue and the cash received and even the amortization all come, in theory, the amortization comes from that row. But really what's most important is the first two columns, the cash that we're contractually obligated to receive, the interest revenue that we need to accrue, and of course the prior amortized cost, the prior carrying value. Because when we sell these debt securities, we need to record the amortized cost of the debt investment when we make that sale. And so again, this is the information that I'm trying to highlight. So for this April 30th, 2021 entry, this is the information that we're going to need. All right, so the cash that we're going to receive when we sell these bonds, we're going to get the price, which is 100.75% of par, so we're going to get $1,007.50 per bond. We also get accrued interest, which again is $80 would be a full year, and of course only 4 months have passed, so we're going to get $26.67 per bond. And so the total cash that we're going to receive is the sum of those two, which is $1,034.17 times the 550 bonds that we sell. So the total amount of cash that we're going to receive is $568,794. That's the cash that we receive. And this is just very similar to the way we had done things with the held-to-maturity security for this part. Of course, the debt investment comes off at that amortized cost, similar to what we had done before, $1,013.85 times the 550 that are being sold. We do have to partially accrue the interest revenue, again from that same row, $77.62, but of course it's only 4/12 because we're only accruing 4 months of interest. Now, we do also need to remove any fair value adjustment or unrealized holding gain or loss associated with these 550 bonds. Now, the unrealized holding gain or loss is a permanent equity account, so it has a balance, and it has a balance that is relevant for each individual bond. So that's why we're taking that off. We're also taking, of course, the fair value adjustment account balance off as well. So the nice thing about those two accounts, if you think about that $3.85 per bond, that is the account balance in both of those accounts. And at the same time, understand that if one of them has a credit balance, the other has a debit, and vice versa. So they kind of offset each other, but they're still part of the journal entry because we need to reduce those account balances for the 550 bonds that are being sold. And so, again, the $2,118 would be applied to each of those accounts. And of course, there may be a gain or loss, and that will end up being a plug. So lots of calculations for this sale that we have to do here. All right, so now we're going to kind of throw it all into a journal entry. The cash, of course, we're receiving cash. The fair value adjustment account has a credit balance, and so when we make this sale, we need to debit the account. Similarly, the unrealized holding gain or loss equity account, it had a debit balance, and so when we make a sale, we need to credit that account. And the debt investment, of course, it's an asset, so it needs to come off the books with a credit, and interest revenue is accrued with a credit entry as well. And so we just kind of do some math and figure it out. And in this case, we have a loss on sale of $3,054. Again, the whole idea here is the amount that we had on our books is more than the cash that we received, and so therefore we had a loss. Everybody still hanging in there? I know it's a lot to digest. Does anybody need to see the previous slide? Kinda, yeah. Yeah, I know. So Harry says unrealized holding gain or loss versus loss. Um, they're similar in notion. So if we have a loss on sale, that means we actually sold it. And so that loss on sale, it's like any other loss. So, whenever you sold property, plant, equipment, you had a loss or a gain on sale sometimes. This is exactly like that. So it's a loss on the actual sale. It's a non-operating item. It is reported as part of net income, whereas the unrealized holding gain or loss dash equity account, that's further down. That's part of comprehensive income. It is not part of net income. And so they are different animals. And so yeah, I'm not. Other than explaining it that way, that the loss on sale is just like any other loss we've ever recorded. Whenever we sell assets, we have gains and losses. Again, this might be an example where you need to walk through it several times. I totally understand that. All right, let's kind of continue on as best we can. So now, again, we have the December 31st, 2021 journal entry for the remaining bonds. Remember, we still have some bonds on our books. So we have to keep marching through the process. So again, we have the amortization table. We're back to that 12/31/2021 row for any remaining bonds. And again, so we're using the amortization table. Of course, we're going to receive the $80 interest payment, but again, it's for the 250 bonds that remain on our books for a total of $20,000. We accrue the interest revenue. Again, it's the full year, again, applied to the 250 bonds that remain for a total of $19,405. And then the debt investment amortization, of course, is the $2.38 per bond for a total of $595. And we put all that into our journal entry. Again, just as a reminder, the debt investment is an asset, and we're reducing it because it had an implicit premium. And so that's why we're crediting that account. Hopefully that journal entry wasn't too bad. Again, I can kind of go back to the calculation. Just the biggest thing there is we're applying all of that information to the 250 bonds that remain on our books that we still own. So that's where we get this journal entry. Okay, so now let's talk about the financial statements. Oh, let's actually take one step further. Sorry. On December 31st, 2021, we still need to make the fair value adjusting entry. Almost forgot about that. So again, we take the fair value of each bond. In this case, we are told that the fair value, they're trading at 102 on December 31st, 2021. And so the fair value for each bond is 102%, which is $1,020. The amortized cost of each bond, again, we have to look at that 12/31/2021 account balance. The amortized cost is the last column, $1,011.47. And so the amortized cost of each bond is $1,011.47, and that's taken from the table. And so the implied fair value adjustment account balance now is actually a positive $8.53 because the fair value is more than the amortized cost. And so remember, if the previous year it had a negative balance, now it has a positive. Will we ever have to do a fair value adjustment with less than level 1 estimates? No. So I'm not going to require that you do anything crazy. I'm always just going to give you the fair value so we're always going to know the fair value reliably. Now in practice it may not be as simple, but for us, yes, this class will be simple. All right, so $8.53. So we go from a negative balance to a positive balance, and so we got to think about how to handle that. So let's talk about that fair value adjustment account entry. So the implied balance is $8.53 per bond. The prior balance was negative $3.85 per bond. So that means we need to increase the balance in our fair value adjustment account $12.38 per bond. That's what we need to do. We need to increase the fair value adjustment account balance. And so that means for the 250 bonds that we have, that total entry will be $3,095. And again, to increase the fair value adjustment account, it's an asset. So to increase that account, we need to debit that account. So the fair value adjustment account is a debit, $3,095. Excuse me, and the unrealized holding gain or loss equity account offsets it for a credit of $3,095. Again, let's go back. You may not quite have finished up the calculations, so let me just kind of go back there and show that to you. Again, this is my process. You might think, oh, I could do that much faster, and you probably can. I'm just trying to be careful. I want to make sure that you can see every step along the way so you can see exactly where those numbers came from. And even now, when I solve these problems, so whenever I write a test, I take the test on my own, and I still use this exact same approach. Okay? All right. Now we have the financial statement effects. So what's going to be reported on the balance sheet? Of course, the debt investment is going to be an asset, and it's going to be reported at the amortized cost. And again, this is the last column, so that hasn't changed. So this is exactly like the held-to-maturity security. So that debt investment's an asset, it's reported at its amortized cost, and it's the last column of the amortization table. But now we also have the fair value adjustment account, and that's an asset, and it's going to be reported at the calculated balance amount. So remember, this is not necessarily the journal entry amount. This is the balance in that account. And then finally, we have the unrealized holding gain or loss equity account. That's a permanent equity account. It's going to be reported as part of accumulated other comprehensive income, which is under our earned capital. So it's kind of right next to retained earnings. And so that again is that whatever the balance that we recorded, that will also be a balance there. And then on the income statement, of course, we still have the interest revenue as a non-operating item. And again, if it's sold before it matures, it could be a gain or loss in sale, which is also a non-operating item. Now, the other thing here is that we will have the change in the unrealized holding gain or loss account is going to be reported as part of other comprehensive income. It's not part of net income, but it is part of our quote-unquote income statement as part of other comprehensive income. You may not realize it, but whenever in U.S. GAAP, if they use the term income statement, you mean a lot of different things. Most students think net income. That's kind of what they think. But in U.S. GAAP, really income is defined as comprehensive income. And comprehensive income is net income plus any other comprehensive income items. And so just understand, we have to think a little more comprehensively about income now that we're in Intermediate 2. All right, let's talk about the debt security balance. Again, we look at the amortization table, and we can see that the carrying value on each of these dates is given through the table. So on December 31st, we have that account balance per bond, applying it to the 800 bonds that are on our books. On December 31st, 2021, again, we have the balance, but of course this time we're applying it only to the 250 bonds that remain. And so under the assets, we would record a debt investment balance in each year, $811,080 and then $252,868. So for both the fair value adjustment and the unrealized holding gain or loss account balances, on December 31st, 2020, it had a negative balance. And then on December 31st, 2021, it had a positive balance. And so when we apply it to each of those two accounts, again, the fair value adjustment account is an asset, In 2020, it's a negative balance. In 2021, it's a positive balance. And on the balance sheet, the unrealized holding gain or loss dash equity account, it's a permanent equity account, and its balance is the exact same as the fair value adjustment account. So negative in 2020 and positive in 2021. So those account balances will always be the same between those two accounts. And again, I know you don't have the table, so I'm going to kind of wait there a second while you fill it out. Okay. So let's talk about the income statement. First, we have the interest revenue for fiscal year 2020. On December 31st, we had our entry of $31,080. Hopefully that one's fairly straightforward. For fiscal year 2021, it was a little more complicated, much like the held-to-maturity security situation. We have the April 30th entry where we had sold those 550 bonds, and we had to record the partial interest for those 4 months. And on December 31st, of course, we have the full 12 months for the remaining 250 bonds. And so the total for each of those years then, non-operating income interest revenue is going to be reported in 2020 and 2021, knowing that in 2021 it kind of has two parts. It has the April 30th piece and it has the December 31st piece. Again, hopefully that's not too bad. It's very similar to what we had done with the held-to-maturity security, of course. On the fiscal year 2020, there was no gain or loss, but in 2021, we did have the April 30th loss of $3,054. And that, of course, is also a non-operating income item. So it was a loss on sale, $3,054. Hopefully that one's not too bad. But I wanted to get to this last item, and it'll all be there in a second. The whole chart will be there. So in fiscal year 2020, the change in the unrealized holding gain or loss dash equity account was negative $3,080. Now in 2021, the change in the account, there's two pieces to it. First of all, whenever we recorded the sale, remember we ended up having to debit the unrealized holding gain or loss dash equity account $2,118. And then on December 31st, we had an adjusting entry which increased the account balance $3,095. So you can see there's two components to what's going to be reported on the income statement for the unrealized holding gain or loss dash equity account, the April 30th entry amount and the December 31st entry amount. Both of them together give you the change in the unrealized holding gain or loss dash equity account. And so the change total was $5,213 in 2021. The change in the account in 2020 was a minus or a negative $3,080. And again, the unrealized holding gain or loss dash equity account is reported on the income statement, but remember it's other comprehensive income. So I'm going to sit here for a second because I know this is probably where now you can see all the different accounts and what's going to be reported. Now listen, while you're still catching up, we're at an hour and a half right now. Now one thing I did figure out last time was that YouTube limits what I can record as a live stream and then post at 2 hours. And so what I'm going to do is once we finish up with the debt investments, I'm actually going to end the stream. And then I'm going to actually create a brand new stream for part 2. And so basically what we'll do is this is going to end up being a 2-part lecture. I'm feeling like I can kind of keep going. Hopefully you all do as well. But what we're going to do is as soon as I finish the debt debt investments part, I'm going to end this stream, and I'm going to immediately start a new stream or create a new stream. So it should show up on my YouTube page pretty quickly, but just so you know. So how do we get the 5,213? If you look at the fiscal year 2021, so on the chart that's here right now, you can see there were two entries that changed the unrealized holding gain or loss dash equity account balance. There were two entries. On April 30th, when we made the sale, we debited, I'm sorry, I think on that date, let me go back. I know it's going to take a while. We'll get there. April 30th, where are we at? Okay, so on April 30th, 2021, notice that we credited unrealized holding gain or loss dash equity account $2,118. That's an increase to that account, $2,118, because again, that is an equity account. And then on December 31st, gotta make sure I don't go too far. On December 31st, we credited that account $3,095, which again is an increase to the unrealized holding gain or loss dash equity account. And so then when we get to what's going to be reported on the income statement, again, I'm going through a lot of stuff here. You can see, I'm getting there. You can see the $2,118 from April 30th and the $3,095 from December 31st. When we add those together, we get $5,213. That is the change in the account throughout 2021. Does that make sense? All right. Trading. The last classification is trading, and just like available for sale, trading debt securities are reported at the fair value. Some of the characteristics, again, the same thing at the initial purchase. There's no difference there. There is a fair value adjustment, but it's a little bit different in that the unrealized holding gain or loss is reported as part of net income. So it's not other comprehensive income, it's net income. And the unrealized holding gain or loss, instead of being a permanent equity account, it's a temporary equity account that gets closed to retained earnings. And so it is a different type of account than what we just looked at with available for sale. So that is the important distinction between available for sale and trading. If the available for sale, the gain or loss, the unrealized holding gain or loss, was a permanent equity account and it was part of other comprehensive income. With the trading security, it is a temporary equity account. It gets closed to retain earnings and it's part of net income. Again, if it's sold, there can be a gain or loss. So now we have 450 bonds, some information about them. We bought them at 97.5. We have the maturity date, we have the trading the bonds, we have all this information, and then all the bonds were sold. So similar idea, we just have to kind of take this information and walk ourselves through things. And so first of all, when we acquire the bonds, we paid 97.5%. Again, there's 450 of these bonds, $1,000 per bond. So in total, we paid $438,750. Now the nice thing about this problem is that the acquisition coincides with the interest payment, so we don't have any accrued interest or anything to worry about. So this is a little bit simpler when it comes to that. So the debt investment, of course, is the debit, and the cash is the credit. So again, we use the time value of money to solve for the yield. There are 5 years remaining in the life of this debt investment. We paid 97.5%, which is $975 per bond. The interest payment, the contractual rate is 7%, so that's why the interest payment is $70, and the fair value is $1,000, and the yield is 7.6199%. Again, the yield should be more than the bond rate because it was issued at a or purchased at a discount, and that is what we find. Again, we have the amortization table. I'm not creating a full amortization table because we sell all of these, and so I'm not going to waste our time. And so again, we acquire it at $975. I just go through 2 rows of the amortization table because that's all we need to solve this problem. Again, the cash received, interest revenue, amortization. Hopefully, all that stuff is coming more secondhand to you now. And I know you have this in front of you on your notes as well. Okay, so now let's talk about that first interest payment, December 31st, 2020. Again, we've done these a lot, so I'm going to move a little more quickly through them. Again, we use that amortization table. The cash that we receive is $70 per bond to the 450 bonds that we hold, so we're going to receive $31,500. The interest revenue, of course, $74.29 per bond, and the amortization, $4.29 per bond. In this case, remember, this is a discount. There's an implicit discount, which means that the debt investment is going to increase through the amortization process, and so these are going to be debits rather than credits. And so the journal entry, of course, the cash, $31,500, the increase to the debt investment through the amortization of the discount, and then, of course, the interest revenue, $33,431. Again, I'm trying to move a little more quickly, but I also know you need to take notes, so I don't want to get crazy fast. Okay. So, again, with this trading security, we do need to make a fair value adjustment at the end of the fiscal year, and we're told that the fair value is 98 on December 31st, 2020. And so now we need to make the fair value adjustment. Remember, we're going to compare the fair value to the amortized cost. And the amortized cost is the last column in the amortization table. So again, the fair value relative to the amortized cost. So the fair value of each bond is $980. The amortized cost of each bond taken from the table is $979.29. So the implied fair value adjustment account balance is 71 cents per bond. So the total entry is the 71 cents per bond times 450 bonds, which would be a $320 debit. Remember, there's no prior balance because these are newly acquired, and so I don't have to worry about the prior balance. And again, the entry amount is an increase to the fair value adjustment account balance, which means it's going to be a debit. So again, we're going to debit the fair value adjustment account, and we're going to credit the unrealized holding gain or loss account. But remember, in this case, it is a little bit different because it's a trading security. And so the way that we're going to designate that difference is by using the dash income. When we say dash income, what we're trying to say is this is part of net income. It's a temporary account. It gets close to retained earnings. Again, US GAAP does not prescribe that this has to be the account name, but we're going to use the same names as the book in order to be consistent. And so again, if we're dash equity, that's a permanent equity account. It's part of other comprehensive income. If it says dash income, then it's a temporary equity account, and it gets close to retained earnings, just like any other income statement item, and it is reported as part of net income. So they are slightly different accounts. All right, so now we have the sale on January 31st, 2021. Remember, we're going to receive both the price plus any accrued interest. The price is $98.50 or $985 per bond. The accrued interest is, the $70 is a full year's interest, and we're only accruing 1/12 of that because it's 1 month for $5.83 per bond. And so the total cash that we're going to receive is $445,874, and because we're receiving that cash, of course, that's going to be a debit. We do need to accrue the interest revenue. Again, the $74.29 is for a full year, but we're only accruing 1/12 of that. And again, we're applying this to all the bonds because we're selling all the bonds for $2,786, and of course, interest revenue is a credit. The debt investment account, we have to think about, okay, what was the balance at the time of the sale? Remember, it's the prior year. So on January 31st, 2021, the balance in the account comes from December 31st, 2020, because that's the prior year in our amortization table for $979.29. So we apply that balance to the $450 bonds for a total of $440,681. And of course, that's going to be a credit because we're getting rid of an asset. We also have to consider the fair value adjustment account. Again, that was 71 cents per bond times the 450 bonds. The question is that entry going to be a debit or a credit? So in the chat, I know it's been a while since I've prompted you to do something in the chat, but I want to prompt you now. Tell me whether or not that fair value adjustment account, whether that entry is going to be a debit or whether it's going to be a credit. Remember, we're selling these debt investments. So Jason says debit with a question mark. Another debit. I'm going to go back a little bit. So here is the prior entry. So Kayla says credit. So given the prior entry, what do we need to do to this account when we sell the debt investment? Somebody changed his answer to a credit. Nicholas, credit, good. It is a credit. Yeah, Jason switched. Yep, credit. Good, 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 good. Listen, it's good to answer and get it wrong. You're going to learn a lot more by doing that. Good, good, good. All right, so it is a credit. And of course, there may be a gain or loss, and that would end up being a plug. And so let's take all the information in there. We have the information we just calculated, the cash, the interest revenue, the debt investment, the fair value adjustment, and then finally, oops, that didn't do exactly what I wanted to, but there is a gain on sale. So the total cash that we received is more than the sum of the interest revenue, the debt investment, and the fair value adjustment. So there is a gain of $2,087. Oh, the date on that is wrong. It should be 1/31/2021. I apologize for that. Let me change that right now. Okay. What's going to be reported on the balance sheet? What's going to be reported on the income statement? So of course the debt investment's an asset. That's the last column. That's the same as we've always done. The fair value adjustment is also an asset. There's no difference between that and what we did with the available for sale. Now, I will say, because that unrealized holding gain or loss account, remember it was a temporary equity account, it is closed. It is not going to be reported on the balance sheet. It's gone. It's zeroed out. It's been closed to retained earnings. So that's all that's going to be reported on the balance sheet for a trading security, just the debt investment and the fair value adjustment account. On the income statement, you have the interest revenue. Hopefully that's obvious by now. Gains and losses on sale. Hopefully, again, that's obvious. And then finally, in this case, we are going to have the unrealized holding gain or loss dash income. Again, this is now part of net income. It's a non-operating item, just like interest revenue and just like a gain or loss on sale. So when you have a trading security, the way that we handle the unrealized holding gain or loss is different. And so that's the important distinction between available for sale and trading. And again, under IFRS, they do not make this distinction. They do not allow the available for sale designation. So when on December 31st, 2021, we take the information from this row, and you can see on the balance sheet, the balance for each debt investment is $979.29. Fair value adjustment is 71 cents per bond. And so that's what we report on the balance sheet on December 31st, 2020. Nothing's going to be reported as far as account balances in 2021 because they're all gone. The income statement. So the interest revenue, again in 12/31/2020 was part of our adjusting entry that we recorded on the sale on 12/31. So in 2021, remember we would have had a sale. So let's go back to the sale journal entry. So notice that on this date when we make this sale, The interest revenue that we report on 1/31/2021 is $2,786. That is going to be reported on our income statement in 2021. That interest revenue amount and also the gain on sale. Both of those items are going to be reported in 2021. There's just not going to be any balance sheet items related to the debt security or the debt investment. All right, so there you have the interest revenue, the unrealized holding gain or loss. Again, that's part of that adjusting entry. And then we have the gain or loss on 1/31 as part of the sale, the $2,087. And all of those items are non-operating items. They are part of net income. And again, on 12/31/2020, we have both the interest revenue and the unrealized holding gain or loss - income account. And in 2021, we have the interest revenue and the gain on sale from the January 31st, 2021 entry. And I should change this. I just realized that. All these slides are new for this summer, so I'm finding all my mistakes now. Okay, last topic on debt investments is this thing called the portfolio approach. So the portfolio approach is an alternative method for making fair value adjustments. It does not change anything else. So the way we record interest revenue, the way we amortize, none of that changes. But it is a different approach to the fair value adjustment. So rather than separately calculating a fair value adjustment for each security, it aggregates everything together into one portfolio. So the fair value adjustment account balance, then, it becomes the difference between the portfolio's amortized cost and the portfolio's fair value. So it's just a way to handle the fair value adjustment. Instead of being security specific, it's a portfolio account. So it's a very big difference. Everything else is the same as far as the interest revenue is concerned and the amortization of any implicit premium or discount for each individual security. So we have this portfolio of debt securities that are classified as available for sale. All bonds were originally purchased at a discount. So we have a lot of information. The amortized cost of the portfolio on the date. We have the fair value on that date. Lots of different information that we need to take into account. Now, I'm not going to read through all of this. It's in your book. It's in your notes. So hopefully you can read through that. But I'm just going to kind of get to the journal entries. So hopefully I can close this up within the next 15 minutes and stay under our 2-hour limit. So first we're going to look at the December 31st, 2020 adjusting entry. Again, we're just worried about the fair value adjusting entries right now. All right, so the fair value of the portfolio is given as $236,850. The amortized cost of the portfolio is given as $238,500. And so the implied fair value adjustment account balance is a negative $1,650. Again, the fair value minus the amortized cost. So that means there should be a $1,650 credit balance to the fair value adjustment account. We are told that the previous balance was a $1,500 debit balance, which means that it was positive. All right. And so the entry to go from a $1,500 debit to a $1,650 credit is a $3,150 credit entry to the fair value adjustment account. So again, it's available for sale, so we're going to credit our fair value adjustment account balance, and that's going to be offset by a debit to the unrealized holding gain or loss dash equity account. Again, it's available for sale, so it has that equity designation. It's that permanent equity account, and it is part of other comprehensive income. So now let's take the sale on January 1st, 2021. So the sale and purchase. So we sold some debt investments. We're told that the debt investments had in that sentence it says the company sold $33,500 of debt securities on January 1st for $34,850. And so you can see that the amortized cost of the debt investment is $33,500. The cash that we receive is $34,850. Because we're using the portfolio approach for the fair value adjustment, the debt investment account does not have a fair value adjustment account or an unrealized holding gain or loss account associated with it because it's not security specific. And so the gain or loss is simply the difference between the amortized cost and the cash that's received. And in this case, there's a gain on sale. And so that we also acquire a new debt investment for $53,000. Of course, that's a debit and a credit to cash. So now we need to do the fair value adjusting entry for December 31st, 2021. All right, so we're told that the fair value of the portfolio is $255,920. That's information that we are given. The amortized cost of the portfolio is a little bit different. Now there's different components to this, all right? So we're going to kind of go back and forth a little bit. So the initial balance of $238,500, that comes from the December 31st, 2020 amortized cost. So we're told the amortized cost of the portfolio is $238,500. Then we sold $33,500 of debt investments, which is why the negative $33,500, and then we acquired $53,000, and so that's why we have a positive. And so then why the last positive, the plus $1,085? Let's again go back to the information in the problem. In the very last sentence, it says at the end of the year, the fair value of the portfolio was $255,920, and the company had total amortization for the portfolio of $1,085. And we're told that all bonds were originally purchased at a discount in the second sentence. All bonds were originally purchased at a discount. And so what does that mean? It means that all the bonds are starting from here and then they're going up, right? So that following that curve, they're curving up towards their par value. So that means any amortization is an increase to the account balance for any individual security. And so that $1,085 must be a positive number. I made this difficult, so this is as tough as it possibly can get. So the amortized cost of the portfolio is $259,085. So that means that the implied balance in the fair value adjustment account is negative $3,165. So that's the fair value minus the amortized cost. So that means that we should have a $3,165 credit balance in our portfolio, but in our fair value adjustment account. The previous balance was a $1,650 credit balance. So to go from between those two, that means we need a $1,515 credit entry to the fair value adjustment account. And of course, that credit is offset by a debit to the unrealized holding gain or loss account, also in the amount of $1,515. Again, taking each piece, the fair value of the portfolio, the amortized cost of the portfolio, figuring out what the balance is, compare it to the prior balance, and we get our entry amount. Okay, so now let's provide the financial statement effects. Let's ignore interest revenue since the information is not provided. So the balance sheet, of course, the portfolio amortized cost on 12/31/2020 is $238,500. On 12/31/2021, the balance in the amortized cost in the portfolio is $256,915. The balance sheet is also going to include the fair value adjustment and the unrealized holding gain or loss, again because this is available for sale. And again, the balance on 12/31/2020 is negative $1,650. And the balance on 12/31/2021 is negative $3,165. And so what's going to be reported, of course, the debt investment and fair value adjustment are both assets, and we're just corresponding what we have above there to each account. And of course, the unrealized holding gain or loss equity account is a permanent equity account, and it's going to have the same balance as the fair value adjustment account. Again, we're running a little tight on time. If I go over 2 hours, it's going to cut this off. So I want to kind of move out a little bit. Income statement, of course, we have the interest revenue, gains or losses, unrealized holding gains and losses. So interest revenue not provided, don't worry about it. The unrealized holding gain or loss, again, this is the change to the account. So on 12/31/2020, we had this adjusting entry of negative 1,650. And the same adjusting entry on 12/31/2021 was a negative 1,515. Again, that's the change in the account, not the balance when we're talking about the income statement. Of course, we did have the gain or loss. We did sell some a portion of our portfolio, and so we had a gain of 1,350. And so all that's going to be reported. So the interest revenue and the gain on sale are both non-operating items, and the unrealized holding gain or loss / equity account is a other comprehensive income item. And again, that's just the information that we were given, calculated through our journal entries. I got a few minutes to spare if you guys have a question. But again, for those that may have not been on when I said it before, what I'm going to do is I'm going to stop the stream, and I'm going to start a new stream, probably in less than 5 minutes. I'm going to try to do it as fast as I can. So if you just pay attention, it should pop up. But that way I can have all this in one lecture. So I'll have one lecture on the debt investment, and I'm going to immediately go into the equity investments and redo that lecture. But if there's no questions, immediately I'm going to kind of sign off and sign right back on. But if you have a question that you want me to ask, or that you want to ask me, now's the time. Okay, trading security. Any idea how long the next section will be? Much shorter, Jason. So the equity securities is probably half the time. I'm guessing it'd be an hour, something like that. No big difference here with the trading securities and the portfolio approach. All right, I'm going to sign off, and I will be right back on.